Hi everyone, Scott Schweiger with Burn CPA here with the second Tuesday tax tips of 2020. Last week we tackled a relatively small change in regards to virtual currency. This week we're getting a little more complex with it, trying to briefly, I stress briefly, I'll do my best, to give you a rundown of the Secure Act that passed back in December. Now, the Secure Act aims to improve retirement security. There are a number of provisions that are included in the Secure Act that affect your retirement and the planning landscape, not to mention the tax consequences. I'll do my best to be brief, and I will list some, and I repeat, this is only some, not an all-inclusive list, of the changes in the Secure Act. So, in no particular order, here we go. Small businesses. You will see some changes to the retirement landscape. In particular, putting a retirement plan in place with auto enrollment may qualify your business for a tax credit to help offset some of your startup costs. This rolls right into another business change. The Secure Act removes some barriers to setting up multi-employer plans. This will allow larger pools of employees, and the hope is that will help reduce some of the costs in maintaining these plans, encouraging more businesses to set them up and give more employees access to retirement plans. Under the Secure Act, you can also open a retirement plan later and still have it effective for the last tax year. Before, plans had to be in place by the last day of the year, December 31st, but this has been relaxed, similar to how you can have a look-back contribution into your IRA. The Secure Act removes age limits on IRA contributions, while also increasing the age in which you must start taking your required minimum distributions, or RMDs. Speaking of RMDs, the rules on RMDs for inherited retirement accounts has also changed and will impact so-called stretch IRAs. This will alter tax and planning aspects for those inherited accounts. Another change deals with annuities. You can now hold annuities in your 401k when previously this was not an option. There are also some expanded use cases for your retirement funds. Similar to retirement withdrawals for first-time homebuyers, parents will now be able to withdraw some funds to help with birth or adoption expenses. In addition to that, up to $10,000 in Section 529 plans can be used to repay student loans. Obviously, the changes mentioned here aren't fully detailed. It's not even all of the changes, but I tried to be brief. How the Secure Act is going to impact you in particular is going to depend on your facts and circumstances. This is not intended to be blanket tax advice. So if you have a specific question regarding your circumstance or on the Secure Act itself, please reach out to your tax advisor or feel free to contact me. Thanks so much for watching, guys, and please join me next week for another Tuesday tax tip.